Good morning, everybody, and welcome to today's entrepreneur presentation. For those of you who I haven't met before, my name is Gary Watkins, and I'm the joint CEO of the Quattro Finance Group. And before we start the presentation, I'd like to play a very short little video, just highlighting the Quattro Group, our services and value proposition, and then we're going to get on to our topic for today. Thank you. So guys, that's pretty much our group in a nutshell. We have got all of our entities represented here. Each one of the Quattro Group companies represents a different aspect of financial services, and it's headed up by specialists in each one. So we have everything from finance and legal, short-term insurance, medical aid, estate planning and wills, right the way through to investments locally and offshore. All of our strategists really represent you as a client. They don't work for any specific insurer. They work for you and represent you as a client to make sure that your needs are always met. Today's discussion, though, is not around insurance. Today's discussion is around advice and around sound business principles for entrepreneurs to be able to adopt to make sure that their businesses are more sustainable going forward, and also to make sure that all protection mechanisms that are available have been well thought through and potentially implemented to negate any risks that your business may be exposed to. So our advice philosophy really is, number one, uniquely yours. There's not a cookie cutter approach where we sit and say that this is the plan for everyone. We have a good, proper engagement with you on a personal level to understand your family dynamics, your personal needs and aspirations and goals, and then also your business dynamics, what strategies you need to adopt in your business, and how to implement these strategies. We embrace technology and use all the tools available to us and to enable us to be more efficient and more effective for you in your business. We are, as I said earlier, financial strategists. So we really get a good, deep understanding of your needs as a business owner, and then we connect you to the appropriate channels and specialists to help make sure that what's in your mind actually plays out in reality. And then probably the most important out of everything is to enable you as the business owner or entrepreneur to make well thought through, informed decisions in every aspect of your business. So often we see business owners, and when we talk to them, the reality really sets them aside, where they sit down and actually look at themselves and realize they aren't the most learned person in the world. They've got an idea, or they've been presented an opportunity, and they've got this business, but they don't understand every single aspect of law, accounting, business strategy, financial, and the likes. So what makes a business owner truly successful isn't his skill set in terms of what he knows, but rather the skills that he employs. He needs to surround himself, or her, surround themselves with smarter people than themselves. And this is really what we're trying to achieve here, is to enable you to be able to meet well-informed, learned people who understand every aspect of your business and your strategy, and try and help you achieve the best possible results in your life. So what we're going to discuss today is just some of the business protection plans. Unfortunately, the topic is far too big to be able to address on a webinar. Types of products you could use, pitfalls to look out for, and then most importantly, implementing the correct structure. So when you're looking at a financial plan, I think what's crucial to understand is that our philosophy is trying to get you to use what you've already created in your life, your wealth at the moment, and enable that wealth to be mobilized to do things that make provision for your family on your death, provision for yourself and your family if you got disabled, and then also help you with your retirement goals. So as an example, one of the things we could do is try to find a strategy for you to be able to sell your business at retirement, and that business sale could then help achieve your retirement objective. Or you keep your business in retirement, but you have a strategy in place where your business can still run and potentially pay you some form of income to sustain you over your lifetime. So when you're looking at proper financial planning, your business forms the foundation of your plan. And then if you need any top-ups for savings, investments, insurances and the likes, that forms part of your personal plan, and that really tops up the shortfall between what your business provides you and what you need or aspire to. And as your life progresses and your wealth accumulates over time, you will find the requirement for saving additional money or having additional insurances would potentially reduce, which would then free up money for you monthly in order to invest further, where you could potentially retire earlier or retire better, or do things that are bucket list items for your family, like overseas holidays or whatever your goals may be. When you're in business, there are a couple of documents that you're going to be presented with if you own a company, as an example. And these documents are your statutory documents, and they really form the foundation of any entrepreneur or business owner's plans. The first one being your Memorandum of Incorporation, or referred to as your MOI. This document is a public document. So I could go to SIPC and I could get a copy of your Memorandum of Incorporation. And the Memorandum of Incorporation really highlights some key elements in your business that if you've got business partners, it would govern the relationship to some sort of a degree. The problem with an MOI is that because it's a public document, keeping private information in the public domain might not necessarily be a good strategy for you to adopt. So as an example, as a business owner, you might need a valuation method to govern how an exiting partner would be bought out. It might be a multiple of earnings. It could be a value according to your assets, whatever it might be. Now, you don't really want to put this in a public domain, because if ever there's a competitor or a third-party buyer, they would have access to how you value your business, which might not be prudent for you. Also, things that are very personal on a shareholder basis. So as an example, I've got a company and I've got 2 business partners, and this business might require funding in the future where I've got to lend it some money. The funding is something that I would like to address on a more private basis, because maybe my business partner or myself don't have the funds to be able to lend, and you might find one of the partners has to pay more than the others in order to fund. So you would like that discussed in a private agreement, not necessarily in a public document. And then also voting rights and quorums for meetings. Again, I don't really want that in a public document. Dividend policies, as an example, that we'd rather contain in a shareholder agreement, which is the second agreement. So the shareholder agreement sits above the memorandum in terms of structure, but the MOI takes precedence. So just to explain that, the shareholder agreement will be structured to contain all your personal private discussions between yourself and your business partners on how the business is run, the directors or shareholders' duties, funding, meetings, quorums, notices, whatever it might be, or dividend policies and the likes. So this falls out of the public domain and into a private domain. But if there's conflict between your shareholder agreement and your memorandum of incorporation, the memorandum of incorporation would take precedent. So it's very, very important that when structuring an MOI and shareholders agreements, you do not have conflicts between them. So they need to be drafted by someone who understands commercial side of business as well as the legal side of business. And that is something that we would sit with you and help make sure that it's drafted correctly. And then the third agreement is buy and sell. Now, buy and sell is a shareholders agreement, but it deals specifically with the death and or disability of a shareholder. So it doesn't talk about meetings or anything else. It only deals with death and disability. And what we advise is that death and disability references are removed completely from your memorandum of incorporation and your shareholders agreement, and rather keep that on a completely separate document. Now, the main reason for this is that a buy and sell agreement dealing with death and disability needs to be reviewed on an annual basis, not just because of a shareholder change potentially, but also loan accounts might need to be taken into account at some point. The value of the interest that the person holds needs to be reviewed on an annual basis. And those valuations documented and signed and updated on that annexure that you have. So because the buy and sell is a living document, it's something that you're working with all the time, it's not something that we'd want to contain in the main shareholders agreement. Otherwise, the entire agreement comes up for discussion every year. And the last thing you want is when money is flowing and something in the shareholders agreement doesn't really sit well with a shareholder, and you're trying to discuss the value of the business, and all of a sudden these other points start creeping in. So you really want to set the foundation, have the MOI, have the shareholder agreement, and leave those in the drawer for a day where there's potentially a boxing match, or you need to find out how to resolve a specific matter. And then have this living buy and sell document, which you can play with annually, review all the time, make changes to it, and it doesn't affect the foundation of your business. So those are the three primary documents that we would look at when assisting you. The business protection plans that you can use, there's a number of them. The one is buy and sell, or sometimes referred to as a continuity plan. The other is contingent liability, where the business owner or director is called upon to sign for debt that the business has acquired, but this shareholder or director has had to sign a personal surety as well. And we'll be discussing that in a bit more detail this morning. Covering a key man, we're not going to be talking about this today, but it's a very important topic which we'll address on one of the next upcoming webinars. So this is where you've got an individual who works in your business, And if that shareholder, I'm sorry, if that individual, it could be an employee or a shareholder, if this individual dies or becomes disabled, your business may suffer a financial impact. You're able to cover this individual and make sure that if that person dies or becomes disabled, that your business will be paid out a lump sum of money in order for your business to survive that loss of that person over that period, to cover your lights and water and your salaries, whatever is needed until you found a suitable replacement. Staff retention plans, also very, very important aspect of business. Again, we're not going to be able to cover that today, but this is really around once you've found a good employee and you've trained and spent time and invested in them, how do you now keep them as part of your team? And then the last one is an exit strategy. So this is when you retire one day, how do you exit your business? Who buys? And we will be discussing this morning as well. All right, let's talk around buy and sell. Buy and sell, a lot of people kind of dismiss, and I think it's very, very important that people understand the risks with buy and sell. Buy and sell compels a deceased person or their estate or executor or assigns to sell the shares in the business and then the remaining shareholders to purchase. Now, in your agreements we spoke about earlier, the MOI and the shareholders agreement, you may come across a term where they talk around preemptive rights. Now, preemptive rights really means that if a share comes up for disposal, the remaining shareholders would have the first right of refusal. In other words, they would have the ability to acquire those shares. The problem with a preemptive right, though, is that it just protects the remaining shareholders by giving them an option to buy, not a compulsion. It does not protect this preemptive right, does not protect the exiting party, because the exiting party, when they leave, they don't have anything that compels the other shareholders to buy. It's only an option. When we convert that preemptive right in the buy and sell to a condition that compels, now we're protecting both the remaining shareholders as well as the exiting. So if I was to die today, my shareholders that are in existence would have the obligation to purchase my share for an agreed value, and myself or my estate or my curators or assigns, they would be compelled to sell the shares to the remaining parties. With buy and sell, it also nails down one key element, which is the value, your valuation method, and the payment plan. It's no use if you got disabled and you had an exit that your shares would be sold to the remaining shareholders, but nobody knew to what value they would be buying, nor how they would be paying. Can you imagine you sitting in a situation where there's a death that's occurred, your shares were worth, as an example, 10 million Rand in your mind, but on your death, there was no valuation method applied. Your remaining shareholders would probably call upon the accountant for the company, and they would ask the accountant to please give them some sort of indication as to how to value the shares. Now, where the challenge comes in is the accountant is working for the remaining shareholders, not for you, because you're already dead. And they've got a number of valuation methods that they could apply to this business. The valuation method that they apply might be the net asset value, or it could be a valuation which has been determined according to its profits that the company has made over a period of time, and a multiple of those products, depending on the industry that you're in. So as an example, if you were in the restaurant industry, it might be a multiple of 3 or 4. If you were in the financial services industry, it might be a multiple of 1 or 2. And if you were in manufacturing, as an example, and you had large contracts, you might get a multiple of 5 or 8, depending, again, very heavily on the nature of the business. So we need to know, because the foundation of your financial plan is the business, on your death, we need to know, what is that value? How much are you going to be getting when you die? And then more importantly, how are they paying? Are they going to be using cash? Are they going to be paying you off on installments at 10 Rand a month, or 100,000 a month, or 1 million Rand a month, what are you going to be getting? So very, very important to nail that down. When we're looking at funding for a buy and sell, insurance is the most cost-effective way of funding it. And the reason I say this is that if I was to pay you 10 million Rand for your shares, and I was going to use cash, my own money, and not insurance, I would need to earn as an individual about 16 million Rand, 15 million Rand, call it, in cash. I would need to pay SARS between 5 and 6 million Rand in income tax to net 10 million Rand to pay you. So the cost of the acquisition in your business of 10 million is 10 million for you, but it costs me 16 million Rands worth of my earnings. I might spend the rest of my working days working my bum off just to raise enough money to pay you for your shares. And by the time I've bought the shares, I would probably be at retirement age and looking to sell what I've just spent the last number of years paying off. So it creates a very, very bad environment where it almost incentivizes the remaining shareholder to misbehave and try and renege on the buy and sell in some way or form, because it's cash penal for me to use 16 million Rands worth of hard-earned cash to settle the 10 million Rand net that I need to pay your estate. I could borrow the 10 million, but I'd be paying an exorbitant amount per month as a repayment to a financial institution. Plus, I'd be paying interest at probably prime plus over that period. I mean, if you just took 10 million over a 20-year term on a bond, as an example, you'd probably be paying very, very close to about 80 grand a month for 20 years, 90 grand a month for 20 years. It's just ridiculous. Where if I used a short-term loan, that repayment would be way, way, way more expensive. If I was to insure you for 10 million, all I would do is pay a monthly premium to the insurance company. I might be paying 2,000 or 3,000 Rand a month instead of 80 grand or 160 or 200 grand a month or 1 million Rand a month. I'd be paying 2,000 or 3,000 Rand a month. And on death, the insurer would guarantee the 10 million Rand payment to me in cash, tax-free. I can then use that money to do the transaction. So insurance is by far cheaper than any other financing vehicle. So this is why people would look at using insurance. And this obviously only applies to people who can get insurance. Some people are uninsurable, and then you'd have another challenge around how you would need to pay. And then most importantly, with this whole exercise is the structure to make sure that it's done correctly. And one of the big provisos is your partner must pay the premium on your life. If you pay your own premium in any way or form, the receiver of revenue will charge 20% of the proceeds as a state duty up to a value of about 30 million. And anything in excess of 30 million, they would be charging 25% for the difference. And that just comes off the top, which would potentially leave you short by the 25 or 20% on the purchase price, which you would still have to fund in cash. So it's very important that that is structured correctly, and we obviously assist in that process. So this is how the estate duty would work. Every single insurance policy that is on your life is what they call deemed property in your estate, and it's subject to estate duty. But if your partner insures you for buy and sell, the purpose of the policy is to acquire the shares in the business, and the premium was paid by your partner. That policy would get an estate duty exemption in terms of section 33A2 of the Estate Duty Act. So very, very important that you structure that correctly, because you could be wasting hundreds of thousands to millions of rands in unnecessary payments just because of a badly structured buy and sell. All right, so the things to look out for in a buy and sell arrangement. Number one is estate duty. Number two, which we just spoken about, number two is the benefits. What benefits you would put on a buy and sell. If your business partner or yourself had cancer on their pinky finger, as an example, we're not going to do buy and sell, because They would get their pinky finger cut off and they would continue working in the business. What we're wanting to do is buy when the partner adds no value to you as a shareholder. And this really comes down on death. When the person's deceased, they add no value because they're not there anymore. And disability. Disability, we often refer to it as a living death. Disability means that you cannot perform your occupation anymore. And if you can't do your job, then the relevance of you in that business is a moot point. Your partner may as well then just buy you out and run that business. And I think what's crucial to understand, guys, as well is that if you add no value to that business and you can't hold office, you can't attend meetings, you can't make decisions on behalf of the business and be operational, then rather get out. Because what everyone forgets is the amount of risk you are exposed to as a business owner owning shares. If that business folds and goes into liquidation, it's going to affect you financially. You want to make sure that you can exit all business risk and get fair value for your shares and go and invest it elsewhere, somewhere where it's safe and somewhere where it's protected, because you're going to need that money to live off for the rest of your life. We've got a couple of clients of ours that we've consulted with who say, when I die, I want to leave the business to my husband or to my wife. And those people, or even children, and those people in the family have got no idea about how this business works. They don't know the day-to-day running of it. They don't know the contracts, the suppliers, they don't know the staff. They know nothing about the business. And suddenly they inherit this business. And then we are faced with massive business risk. Some of the business risks we've been faced with just of late, as an example, like COVID, has really highlighted the importance of why you need to exit and not leave your shares to unskilled family members. When COVID hit, it disrupted business on levels like you could never, ever have dreamt about. You as a business owner had to deal with the sudden rapid change in business, and you had to adapt and adopt new philosophies in order to navigate your way through COVID. Some people had to work from home. Some people didn't. Some businesses closed during COVID. That might have been suppliers of yours or clients of yours. And suddenly you have to go find new clients or new suppliers. Now, if you've got someone who's ill-equipped in the business, doesn't understand your business, and you've died and left them the shares, how on earth would they be able to navigate their way around those types of hurdles? The person who started the business, who understands the business to its nth degree, they battled through COVID. Can you imagine the outpouring that it would have on a family if they just lost their father or their husband or their wife or their mother? They'd inherited shares in something they know nothing about, and suddenly they've got this COVID blanket thrown at them. They wouldn't have a cooking clue as to what to do, and they would potentially end up losing that business, and whatever value it had would have been taken away from that family. Any income that that business had that was generated for that family would have been lost, and it could have left that family destitute and potentially put them into a position where they went through a liquidation or a sequestration process where they lost everything in their lives. People who own property companies as a business and rent out property also very often decide to leave it to family members or leave it to a family trust. Again, these people have got no understanding about property. All of a sudden, COVID comes, tenants vacate, no leases get renewed, and you've got a whole lot of property that's worth millions with vacancies and no rental income coming in, but massive bond payments to make, rates and taxes to pay, finding agents to try and find new tenants, and they've got no idea where to find this. And the income that the family were receiving has dried up completely. Again, put these families into a situation where the banks now come knocking on the doors wanting to foreclose because they don't have the funds to be able to service the lights and water, rates, bonds, and shortfalls that these property companies have. So I urge anybody, before you make a decision to bequeath shares, sit down with a strategist and understand the inherent business risks that you are putting your family in front of, and make an informed decision as to how you see the succession of your business continuing if you are not selling. If you are selling, fantastic. You are guaranteeing your family fair value, you're guaranteeing an exit, and you are also enabling your surviving partners to carry on with that business in whatever way or form they see fit. But your business partners aren't sitting in a situation where they're suddenly inheriting new business partners who add no value, they don't have the same philosophy or ideas around the business, and potentially are wanting a different outcome. We've seen a lot of business owners where the business owner dies, the remaining shareholder is left now with the wife or the husband as a new business partner from an inheritance perspective. And that new partner, all that they're looking for is income. They don't want to be operational, they just want dividends. But this poor business owner that survived, his strategy was to grow the business, and he wants to retain the earnings and reinvest the profits into growth. And the other shareholders not wanting that strategy, they wanting cash. Now you've got two misaligned business owners in a company, and all you've done is create a tension between them, and your remaining business partners left in a position where they now need to look external from that business in order to achieve their objectives. And now all of a sudden, your family is stuck in a business where that business owner is not wanting to work in it anymore, and they're wanting an exit. And your family don't necessarily have the skills or the means to be able to continue running it. It just causes bad behavior. On the disability definitions, you must be very careful as to how you interpret disability. We've seen agreements drafted where the notary has written in that if your GP books you off work for 3 months and he deems you to be disabled or incapacitated, your buy and sell takes place. I mean, that's crazy. You have a car crash, you break both your legs, you're in hospital for 4 months in traction, and suddenly your business is up for sale. Doesn't make any sense. That's a temporary disability. You want to only sell your business if it's permanent. Also with disability, you get different definitions. You get occupational disability and you get own occupational disability. Both definitions cover different events. So you've got to make sure your disability definitions are really well thought through and documented correctly. And then very importantly, make sure that the disability definition that the insurer uses for the payment of the disability benefit is the same as your agreement. You don't want to have two different definitions where your agreement calls you to buy or sell, but the policy doesn't pay because that definition has not been met. Or the converse, where the policy pays out on definition, but it doesn't call for a buy and sell. They must both be exactly the same. Terminal illness, also another very, very important area to understand. Every single insurance policy on your life has got a terminal illness benefit, often confused with dread disease cover. Terminal illness is not dread disease cover. Terminal illness is where you are diagnosed to die by a doctor within a 12-month period. So bad news, Bob, I'm sorry to tell you, but you've got terminal cancer. You have only got 8 months to live. That is a terminal illness claim. What happens is the insurer will advance the life cover to you or your partner, if it's a buy and sell, before you die. So we've got a situation where you've got two business partners. The one gets diagnosed terminally ill. The policy pays out the 10 million rand to the surviving partner in advance. So your partner's now got 10 million rand payout on your life. But you're not dead and you're not disabled. You are dying, but you're not dead yet and you're not disabled. Your partner's got 10 million rand tax-free cash if the sum insured was 10 million, with no obligation to use that money to buy your shares. It puts you in quite a precarious situation because the buy and sell might only be dealing with death and disability. So now you're watching this shareholder take the money and do whatever they want with it with no compulsion to do the buy and sell. And again, it could potentially lead to your partner going rogue and not complying with the buy and sell agreement that you have put in place. Preemptive rights, another thing to be careful of. Do you have preemptive rights in your shareholders agreements or your MOIs? We spoke about it a bit earlier. Preemptive right protects the remaining shareholders by giving them the first option to buy the shares, but there's no compulsion. We have had a couple of businesses who didn't have preemptive rights, and the partners had a bit of a disagreement, and one of the partners decided to sell their shares to a third party and never had to offer them to the remaining shareholders first because the preemptive right wasn't there. The new third party bought the shares, and suddenly these guys were in business with a brand new shareholder they had never met in their lives before. This again can cause absolute heartache in a business, particularly if there is tension between the parties. Also, without preemptive rights, you might end up in a situation where a competitor of yours ends up buying shares in your company from one of your shareholders, and that competitor, as a shareholder, has access to all the company information, your shareholders' agreements, your company's financials, all the debtors and creditors, all the customers, all your staff, everything. And if they're a competitor, they could potentially use that to their advantage in the other businesses, and again, put your business at massive risk. So preemptive rights are very important to know whether you've got them or not. Repudiations of claims is another thing that we really come across a lot. So you've put your buy and sell in place, you've ticked all the boxes, you've got your policies in place, everything's great, but somebody lied or forgot about some medical information. And due to that, the policy does not pay. The buy and sell agreement is a legal binding contract. It forces the party to sell and it forces the other party to buy. But there is no funding mechanism in place, which means that you may be called upon to pay in cash. And this could lead to you personally being cash strapped for a very, very, very long time, or defaulting and being held in breach. So we've got to make sure that we contemplate repudiations of claims. Expiration of risk benefits, also very crucial, particularly around disability. If you've got a disability buy and sell in place and your shareholder gets disabled at 66, but the disability benefit expired at age 65, again, you'd find you don't have a funding mechanism to do the purchase. You would need to be paying in cash, and you will be called upon to do so in terms of the agreement, which might also put you into cash flow predicaments or put you in breach. And then company and trust ownership. This is quite a difficult place for a lot of business owners to try and navigate. If your shares in a company are owned by a trust or another company, or your business partner, in inverted commas, the person that you went into business with, holds their shares in another company or in a trust, it adds a whole new dynamic to your entire buy and sell. In fact, your whole strategy changes completely. We come across this a lot when there is black empowerment structures in place as well. Many black empowerment structures are done with a black empowerment partner company, not a black empowerment partner natural person. And we have got a lot of things around preemptive rights, the notifiable transactions when the black empowerment company or the other company that holds shares in your business is up for sale, the death of the shareholder of the other company. Remember, a company doesn't die, neither does a trust. So when you're doing buy and sell, it's no use doing buy and sell with your partner, who's the trust or the company, if that person or if that entity is never going to die. They would need to nominate somebody on behalf of that business to be the insured representative. And on that person's death, the company or trust would sell its shares. But that's a whole different discussion. What we offer is we will sit with each one of you and we will do a full due diligence and go through your shareholding, how your structure is, everything. And we don't charge for that. We'll do that all for free and give you a very good understanding on what risks you've got and what strategy you need to adopt. After that meeting, if you want to engage, then we'll discuss how we work going forward. But it's an invitation for you to really understand what is going on in your business, what risks you really are facing, and how you need to act in order to mitigate these risks. So the results of no buy and sell agreements is your surviving partner might trade your business down to nothing. Your shares have been left to your family. They trade the business down to nothing, and they actually start opening up a different business on the side, and they work for themselves and misbehave, which leads to your family being broke. You might also find yourself, if you don't have an agreement in place, where there's no third party to buy. So I'll give you an example. You and I have a business, we're 50-50, you die. We don't have a buy and sell agreement. I go to your family and I say, guys, I want to buy the business. Here's R1 million. And your family say, no, the business is worth, shares are worth 10 million, not 1 million. And I say, well, I'm not prepared to pay 10 million. This is a willing buyer, willing seller transaction. I'm only prepared to pay $1 million, and I only have $1 million. Your family and the executive sit down and say, guys, listen, this is worth 10. We've been offered 1. We're losing 9 million. We're going to go find a third party to come in and buy these shares. So off you run and you go find a third party, and the third party comes back and says, you know what, it is a sound business, but the fact that your shareholder has died, it's affected the value a little bit because this person's IP is now lost. So what we would like to do is we'd like to make you an offer of 6 million, not 10. The 6 million is greater than the 1 million I've offered. So you guys are keen to pursue that. So we have our first meeting with this new shareholder that you're bringing on board. And I act very hostile, and I don't come accepting at all in any way or form with this new shareholder. That shareholder decides, listen, I'm not going to come in and buy. I'm not putting 6 million rand of my money into a business with Gary Watkins. That guy's Fruit Loops. I'm out. All of a sudden, your family's now sitting in a very hot situation where they can't sell these shares now to anybody because I'm misbehaving. The only person you can sell to is me, and I'm only prepared to pay the $1 million. It's very, very, very penal for a family to be in that position. So we advocate you've got to have a buy and sell agreement. Your family ends up getting less than actual value. Your competitor might become a new business partner, or your ex-partner's wife or children become your partner because I was disabled or I died and I left my shares to my family or my family trust or my curator, and suddenly they're fiddling in the business and becoming a little bit of a bugbear for you. Bearing in mind also, when you're a shareholder and an employee, you're entitled to income and dividends. You've got a job, so you get a salary, and you get dividends if you've got a shareholders agreement that pays dividends and you're making profits at the end of the year. The remaining shareholder who's doing all the work is paying out 50% of the profits every year to the deceased estates or heirs or beneficiaries, the new partner. And they get to a point where they go, you know, this is rubbish. I'm doing 100% of the work and I'm giving away half the profits. I can't do this anymore. I want more salary. And your partner says, well, we don't want to pay more salary because if we pay you more salary, it means there's less profit, which means we get less dividends. This is a recipe for absolute disaster. You're fighting between income and dividends between shareholders. The one shareholder's got both, the other shareholder's only got the dividend. In the absence of a dividend policy in place, the surviving partner's business is fine because he just draws a salary and bonuses and everything else. But the deceased's heirs, they're sitting only getting the scraps, if there is any. But if that company never declares dividends, you could potentially be in a situation where you're holding an asset that's worth 10 million rand, but it's not paying a dividend indicative of a 10 million rand value. You may as well have just sold it then. If you're not getting a dividend return that is commensurative with a 10 million rand value, you may as well have sold. Rather go invest in 10 million somewhere else and get a proper return on your money. So please, if you don't have a buy and sell agreement, get one in place. The next one is just around sureties. This is where you are exposed to a personal surety. It's very common in business. So here's the example. You and I are in business together. We have got a company and we need to finance some machinery. The new machine is going to cost 5 million rand. The company puts a 1 million rand deposit down and we borrow 4 million from the bank. The bank will ask the company directors to please sign all the documentation for the loan. Included in the documentation is a surety document. The surety document often refers to the signatory, the company, and the shareholders as jointly and severally liable for the loan. Co-principal debtors, unlimited sureties. What these things mean is that the business is liable for the debt, the signatory is liable for the debt in their personal capacity on a personal shareholding basis, and the signatories, shareholders or directors and company are all equally, jointly and severally liable for the entire amount each. So if we've borrowed 4 million, you have to pay 4 million as a surety. I've got to pay the 4 million as my surety, and the company would also have to pay the 4 million. And the bank can come to any one of the three of us for their money. A lot of business owners don't understand the implications of this. When you read the document further, they sometimes refer to the excusation clause being waived. What this means is that when the bank want to come and get their money, they don't have to follow the normal route of debt redemption. They don't go to the business first and say, hi, we want our 4 million rand back. They can go straight to the estate of the deceased person and get the 4 million from the estate. That's what a personal surety is. A personal surety is the saying, here is my asset base that I've earned over my lifetime. I've paid income tax on my money, and I've got this money saved, either in the form of my family home, my car, a second property, an investment, a share portfolio, whatever it might be. All your personal assets you are giving to the bank as security against that loan. When you have any business risk that changes for the bank, they have the ability to call upon that money. So I'll give you an example, again, using COVID as one of the most important ones. When COVID came, a lot of businesses, trade literally came to an end, but they had facilities with banks. The banks wrote to these people, phoned these people and said, you've got a 4 million rand facility with us. We are going to be reducing it by 500,000 rand a month. Finished and clear. No argument, no discussion. We are reducing your facility by 500,000 a month. The business owners would say, we can't afford you to reduce the facility. We need it. And the banks say, I'm sorry, your business has got too much risk for us. This is what's happening. Finished and clear. So that business owner now, if they can't settle that loan or overdraft or whatever at 500 grand a month, the bank will go straight to that personal estate and take the money. A change in risk for a bank is also your death and disability. Remember, you and I went and borrowed 4 million from the bank. The bank gave us a loan after we had submitted the company's financials, your and my salaries, and our assets. They asked for our assets and liabilities. We gave that all to the bank, and based on all of the information, the loan was granted. If you die, the risk has changed to the bank because you are no longer involved in the business. Only I am. So the risk's already higher. The fact that you've died means the business probably is not going to be as successful as it was when you were alive. The risk has gone up. The bank will now want to move to protect themselves against this loan to make sure it can still be serviced. The excusation clause was waived. They'll go straight to your executor and say, hi, Mr. Executor, Bob, who's you, has just died. He assigned personal surety for 4 million. Here is the excusation clause waiver. Here's the agreement. I want 4 million rand, please. And there's nothing at all stopping the bank from coming to your estate and taking that 4 million out in any way or form and settling that debt in the business. I am the surviving shareholder. I've benefited immensely because I had a buy and sell with you, and I bought your shares at fair market value, and your estate received the proceeds. I bought the company from you for 10 million rand. The 10 million rand cash was paid by the insurer. It went into your estate, the 10 million, and the shares came back to me. So I traded my 10 million rand policy proceeds with your executor to buy your shares. So that's happened. You now don't have shares anymore. I've got the company 100%, and the 10 million rand cash proceeds is sitting in your estate. The bank now go and take 4 million of the 10 million, because it's cash, it's there, it's readily available, and they settle the loan in the company that we used to own, that I now own on my own. So I've got a debt-free business, and you have just paid 4 million rand to settle that debt. And there's nothing stopping the bank doing that, because the agreement you have signed, that surety, allows them to do it. We've had business owners saying to us, oh, rubbish, that'll never happen. Let's say it was a bond as an example. There's a property company, it owns a property, and there's a bond. You and I signed joint and several surety, co-principal debtor, unlimited, excussion clause waived. You die, I buy your shares, the money goes into your estate, and they believe that this bond will continue to run. You believe it'll continue to run, and it'll carry on running, provided the business rent still keeps coming in and that bond is serviced. So you think it'll never be called upon. I challenge that very simply. Let's go to your bank and let's ask them. When you phone the bank manager, you'll probably get a response similar to this. No, long as the bond is being serviced, we won't come in and call that money up. And we say, well, that's fantastic. Thank you very much. Can we have that from you in writing, please? And this is where the tacky hits the road. If you can't get in writing from the bank that they are not going to come to your estate, it means that they can. And you have to make provision on that basis then that they can. Remember, the excussion clause gives them, by waiving it, gives them the ability to go to your estate. So they have in writing, in a contract, binding, that they can come to your estate. The only way that that changes is if that contract changes. In other words, they must revoke your surety. If the bank are willing to revoke your surety, then you have nothing to worry about. But if they won't, you have everything to worry about. A lot of people say, I don't want to cover the liability. Well, the reality is you have covered the liability already with your assets. The day you signed the surety, you said, here's my assets, come and take them if you need them. So you have covered the liability. What we propose is changing your whole structure. We put a policy in place on your life with an agreement. When you die, or I die, or get disabled, the company will receive a policy payout, and that company policy payout will be used to settle the debt that you have signed for. It then allows us to get the surety released from your estate, which means that your assets are now protected from that surety. Your family can keep all the assets that you've left for them behind. They can keep all of those assets. The company has settled its own debt with its own insurance policy on your life, and you are now safe. The agreement compels the company owners to use that money to settle that debt. You can't just put the insurance in place. You have to have the agreement. Remember, when you die, your executor actually steps into your shoes. They become you. They are liable to pay all your taxes, your capital gains tax, your income tax, estate duties, all of that stuff. They are responsible for winding up your estate. Part of winding up the estate is getting rid of all the sureties. So when you die, they actually write off to the financial institution saying, hi, Bob has died. Does he owe you any money? Has he signed any sureties? Because if he has, we need to get those released so that we can now execute the estate and distribute the assets in accordance to the will. So the bank will know when you die, because the executor is going to phone them and write to them and ask them to get that surety released. So you can't duck and dive it. It's going to come out. So how it works is the company owns a policy on your life. The company pays a premium on your life. The company is the beneficiary of the policy, and the owner, you are just a life assured. When you die, whatever you are exposed to as a risk is covered by the policy. The proceeds pay into the company's bank account. The company then uses that money to settle the liability. The contract makes sure that the policy is used to settle it, and that the estate is now released from its surety obligation, and your executor can continue winding up your estate. And that's really contingent liability. Very, very simple, but incredibly important to understand, because it's probably one of the biggest holes in most business owners' financial plans. If you don't have an agreement in place, your personal estate will have to settle all the company's debts that you have signed surety for. Overdrafts, loans, credit cards, HPs on vehicles, HPs on machines, bonds on property, whatever it might be, you are liable. Your personal assets will be sold to raise the cash, and if they are sold, it's done on an auction. There's no Pam Golding sign or AKITS or whatever sign on your house for the next 12 months to try and settle. The executor wants to wind this up as fast as possible. There's a big chance of not recovering the cash back from the business because you don't have a reciprocal surety document with your existing shareholders. So it would be a litigious thing where you'd have to go into litigation to try and get this money back from the business, and that can take years. And in the meantime, your estate has been declared insolvent. So really, really, really something that you guys need to understand. And then the last part is just designing an exit strategy. There's nothing really to talk much on because every business is different. But some of the things that we look at is, firstly, is your business saleable? Some businesses are really person-centric. In other words, the business is designed around you. It is you. You are selling yourself. It could be a service. We need to understand what your business is and find out, is it saleable? If it's not, could we make it saleable? Is there a strategy we can adopt to make it saleable, because it then creates value? If it can never be saleable, then we need to understand that, and we need to plan on a personal note only, and just mitigate your family from any potential risk that that business may have exposed them to in your lifetime, that on your death, those risks are gone. If it is saleable, we now need to start understanding who is going to buy your business. Is it an individual or is it a corporate? How is this person or corporate going to buy it? So maybe your business is too big for an individual to afford, and maybe it's too small for a corporate to be interested in. So we need to understand your business, understand the growth strategy of your business, and then develop an exit strategy and try to find a suitable buyer for the business. It's a very important process to go through. But what we don't want is to make your business a life sentence where you can never sell it, but you thought you could. We have got so many people who have got to retirement age and they've still got this business and they still have not got a strategy in order to sell. And they are having to live their life throughout their life, watching this business like a hawk. And it's crazy. If you just adopted a strategy, they could have retired properly, where now they'll never retire. And they're always going to be exposed to business risk. A lot of people say to us, you know, I'm never going to retire. I'm going to work till I die. And that's phenomenal. Keeping yourself and your brain active, I think, is a great idea to have. When we talk about retirement, we talk about a day where you are able to stop working. And if you do work, you're working for fun, not because you have to. So financially be able to retire is one thing. And then if you're working, it's a completely different thing. Where a lot of guys don't do that. They plan to work forever, not because they want to, but they now have to work forever because of a lack of planning. So we would like to create that environment where you can work if you want to. If you don't want to work, fine. Also, another thing to bear in mind, when you get older, you don't necessarily get healthier. You might find a deterioration in your eyesight, in your memory, in your bodily functions, in your capacity just to operate daily. You must be able to still continue to work. And if you can't work due to health reasons, you must be able to afford to stop working and have a strategy for that business to still continue. Remember one thing with business, it's very much like marriage. When you got married, you had a responsibility to your spouse. When you had children, your responsibility ticked up another level because now you were responsible for your spouse and your children. If you're a business owner, you're now responsible to your wife or husband, your children, your business partner or partners, plus every single one of your staff and their families. Remember, every staff member you employ, they need to know that there is a plan in place that this business can continue after you have stopped. They need to know that there's some form of succession, because they need to still bring food home every day for their families. They still got to pay for school fees and stuff. It's no use you dying and having no plan, or getting disabled, or retiring and having no plan, where suddenly you put 100 people out of work, and those 100 people feed another 3 people at home each. You got 400 people depending on a business. It's so important that you understand those responsibilities, and you take action, and you make sure that those people are protected. That's really the end of today's presentation. I want to thank you all very much for listening. I hope there was a little something that you did learn from today's talk. I would encourage you, if you did find any value, to please get hold of us. We host these webinars on a regular basis, and we talk on different topics. And I would encourage you, if you did find any value, to please attend the next one. You're also very welcome to invite any friends, work colleagues, or associates who you feel might benefit from a discussion like this. The topics that we generally discuss is entrepreneurship and business, which is really what we focus on as a company, helping entrepreneurs to better themselves, better their businesses, and business growth specialists is one of the key attributes that we put our name to. How do we grow your business and make it better? We also speak on personal planning. We take the smoke and mirrors out of the industry and really try and explain what you need to be doing as an individual, as a father, a husband, as a parent. What do you need to be doing to make provision for yourself, for your goals? What are your fears? And how can we overcome those fears and put a strategy in place to secure your family's well-being? We talk around investments, investing locally, investing internationally, how best to invest, how to diversify, how to mitigate risks, risk profiling, many different topics. And then we also speak on retirement. We've got a specific talk around retirement and exit strategies for businesses as well. So I really do encourage you to keep in contact with us and join us again. So happy Friday for those in KZN. It's going to be a chilly one this weekend, but I hope you all have a fantastic one, and root for our Boca this weekend. We're playing Argentina, and I really pray that we can show them up like we did the Lions. But yeah, thank you very much, and I look forward to chatting to you guys again soon.